In recent months, a growing chorus of respected investors has raised alarms about the trajectory of global financial markets. Central to these warnings is the so-called Buffett Indicator, a valuation gauge often attributed to Warren Buffett himself. This ratio, calculated as the total market capitalization of publicly traded stocks divided by the gross domestic product, GDP, is widely watched as a barometer of whether stock markets are overvalued relative to the real economy. Historically, Buffett has noted that when this indicator climbs significantly above its long-term average, it suggests markets are in dangerous territory. At present, the Buffett indicator is flashing red. Equity valuations are at levels far above historical norms, with price-to-earnings (P/E) ratios extended to extremes typically seen prior to sharp market corrections. Despite this, retail and institutional investors continue piling into risky assets, stocks, real estate, speculative tech ventures, and private equity, driven by the momentum of years of ultra-loose monetary policy and the fear of missing out on further gains. Warren Buffett, however, appears to be positioning himself differently. While many market participants ride the current wave of euphoria, Buffett has been reducing positions in several high-profile stocks and allowing his cash reserves to swell. Berkshire Hathaway's recent financial statements revealed tens of billions of dollars in cash sitting on the sidelines. Such a cautious stance suggests that Buffett is preparing to act not in exuberant times, but when opportunities are abundant, most likely after a meaningful correction or downturn resets market valuations. Importantly, Buffett is not the only veteran voice expressing caution. Other seasoned investors, such as Jeremy Grantham, Marc Faber, Jim Rogers, and David Rosenberg, have been warning for some time that asset prices are dangerously inflated by years of low interest rates, fiscal stimulus, and speculative behavior. Grantham, co-founder of GMO, has highlighted stock valuations as being in bubble territory, and has drawn parallels to past market manias. Marc Faber, well known as Dr. Doom for his contrarian warnings prior to past crashes, has likewise cautioned that central bank policies have distorted asset prices and created systemic risks. Jim Rogers, a long-term commodities bull and market historian, has voiced concerns that another severe bear market may be looming, citing excessive borrowing and debt-driven growth. Meanwhile, David Rosenberg, a prominent economist, continues to argue that underlying economic fundamentals simply do not support valuations where they stand today. Taken together, these voices stress the widening disconnect between financial markets and the real economy. While GDP growth is slowing in many regions and inflationary pressures remain persistent, stock prices have marched higher, seemingly impervious to real-world headwinds. Such a divergence is what makes the Buffett indicator particularly important. It highlights when equity prices have become untethered from the economic foundation on which they ultimately depend. In summary, the Buffett indicator's current reading should not be ignored. While investors continue to chase returns in overheated markets, Buffett and other legendary figures are exercising restraint, raising cash, and waiting for the inevitable repricing of assets. History suggests that when the caution lights are flashing red, prudent investors would do well to pause and reassess. It may not be a matter of if the correction comes, but when. If you found this analysis insightful and want to stay informed about key market signals and warnings from top investors, please subscribe to the channel. By subscribing, you'll receive updates and thoughtful commentary on financial markets, helping you make better investment decisions even when the Buffett indicator is flashing red.